we've seen time and time again that some of the hurdles on the legal side have been overcome successfully by Trump administration. I think this is not going to be the exception, where I think ultimately the Supreme Court potentially could back Trump's view on trade, and this is probably going to be only a temporary setback.
Okay, so expand on this for me, because traders are calling this the taco trade. Trump always chickens out. From an EM standpoint, do you see these tariff threats as a really serious block to investment opportunities, or is the playbook now to fade that noise and wait for the U-turn, potentially if the White House appeal is successful and Trump indeed does go ahead with his tariff plans?
Well, it depends whether you think you know exactly what Trump had in mind when he started the trade negotiations. And I think, of course, if you look at what's been the result of this, it's been so far going into the Trump's hands. So I think the de-escalation of the trade war clearly is a great opportunity for emerging markets. And what triggered the exodus from the U.S. assets to an extent is actually a positive spillover effect for the emerging markets. And of course, the trade itself continues, and we're looking at de-escalation that will help to rebalance investors' flows back to Asia. We're actually seeing some of the green shoots now, investors asking for Chinese product, Chinese equity product. Investors are still buying into India. So I think this is going to be a great opportunity now that the dollar is going to be weaker. So that's something that has been obviously hampering emerging markets currencies. So interest towards local currency market now is significantly higher than it was in the last 3 years. So for us, all is good with the de-escalation of the trade war.
Yerlan, that's a really interesting take, because, of course, these tariffs have really been a volatility trigger for EM debt and EMFX. So where else is the opportunity for investors if, indeed, calmer seas will prevail on the tariff front?
Well, we're seeing interest towards Asia coming back, as Asia has been obviously under a lot of pressure. We're looking even at the Chinese renminbi, as we know that the surprise revaluation of Taiwanese dollar now prompted discussions among the investors whether there's a secret deals that are going to be unveiled in July on the currency revaluation for certain Asian players. Of course, we're looking at China, potentially looking at South Korea. So there's a very interesting opportunity, I think, to go back to Chinese fixed income market as well, where real rates are quite interesting and attractive. And we also will see continuous support for the economy with more rate cuts in store. So I think there's going to be a good opportunity even to look at the Chinese domestic fixed income market. Of course, we're also seeing the interest towards Indian assets generally. We know the equity have been attracting a lot of flows. And of course, now we're looking at some of the investors globally looking at Indian fixed income market, which is really a great opportunity as well. But of course, we know that Latin America represents still a very great opportunity for us to look at from the commodities perspective. If we're really stepping back from the cliff that trade war ignited, war is around the global slowdown. Now I think we are stepping back and looking at some of the commodity players which suffered as a result of those worries. So I think overall, of course, we are in a region that is really booming. Dubai, UAE, this is also where we're looking to put more money into.
Okay, that's a really interesting take as well. If we have it, I want to just pull up what we're seeing right now across the yield curve as well, because the spike that we've seen in yields has obviously been a key concern for risk asset investors. This is also moving off the headlines on trade in the United States as well. And this new bill that Trump is essentially trying to pass here, which would cut taxes and increase defense spending. At the same time, as we see the 30-year Treasury yield now holding at around 5% here, the question for you, as someone who is an expert in the EM space, I mean, how much more resilient can EM assets stay when we see this kind of rate pressure across the curve, with the 30-year tracking at 5%?
You're absolutely right. We're looking at the steepening of the curves not only in the United States but across the world, including the emerging markets. So we're positioning ourselves in the belly and the front end of the curves, depending on the market, but clearly short duration overall. So I agree with you that there's a fear that we're going to have maybe a disorderly exit from the U.S. Treasury market, which I don't think this is going to be our base case scenario. Of course, we need to factor in those fiscal worries that we have now with the new bill, as you mentioned, and that is effectively is pushing the longer end being higher, and of course the curves steeper across the world.